Hello everybody and welcome back to this channel, this on financial analysis. And today we are going to be looking at Maersk. So once again, we're looking at the financial statements. This is not looking at investment advice. This is not saying whether you should be buying the stock. This is really just helping you to read and understand and interpret financial information. Now, Maersk, you may have heard of Maersk. They are a very large shipping company. So here they are, AP Møller Maersk, also known simply as Maersk, is a Danish shipping company active in ocean and inland freight transportation and associated services such as supply chain management and port operation. So look around you, in your house, odds on, most of the stuff or a lot of the stuff in your house will have been on a container ship owned and operated by Maersk. They're the largest container shipping line and vessel operator in the world from 1996 until 2021. So there is the company, and let's have a look at their financial statements. Now, before we jump in, please do remember to like, share and subscribe to the channels. So if you like what you hear, then please do like the video. If you subscribe, that means you get notified about additional videos. And obviously, if you want to make a comment, if you want to ask a question, then please do use the comments section. But please do be polite in those comments. And all of our viewers are obviously very, very polite indeed. So without further ado, let's jump in and have a look at the financial statement. So here is the 2021 annual report. And this annual report will tell you all about what Maersk are up to and their supply chain management, what they're doing, who they're doing it for, what their strategy is going forward, emissions targets, etc., etc., etc. Okay, and we are interested in the financial statements, which are here. So here are the financial statements. Let's zoom in so we can see them in a little bit more detail. So here is the income statement. We are dealing in dollars. We're dealing in millions of dollars. So when we look at the sales, we can see it's about $62 billion of sales, $62 billion of sales. So 61,787. Now, this is a substantial increase on the previous year. So compared with the previous year, you're looking at about a 55% increase in revenue. Now, it's worth understanding the way Maersk's business model runs at this point. So in effect, their clients buy space on boats, or what they like to call vessels or ships. And the space on a boat effectively is set by the market. So a little bit like the price of oil is set by the market, the price of space on boats is set by the market. The oil is traded through the oil exchanges. The space on a boat is traded through what's called the Baltic Dry Index. So when you don't have very many boats who are sailing around the ocean, you may remember Everclear that got stuck across the channel, for example. If there are not so many boats out on the ocean and lots of people are demanding stuff and wanting stuff shipped from A to B, then the price of the space on that boat goes up, and that is really driving these guys' revenue. And you'll see very quickly, and we'll come back to it, but you can see that that is translated into the bottom line, where they've seen their profits increase from about 3 billion to 18 billion. Now, again, there's a cyclical nature to this business. So what's going to happen now is that lots of people are going to build boats, and there's going to be a lot of supply of boats, lots of space on boats, whereas you often find in the economy that people kind of calm down. They're not going to be buying quite so much, and therefore demand comes down, the supply of space goes up, and then it sort of effectively self-corrects. So there is a cyclical nature. This isn't that they kind of turn the corner and they're going to be making $18 billion a year from now on, for example. So we would expect that that 18 billion comes back down to a kind of a more, what we might call normalized amount. So previous year, bottom line margin about 7%. This year, bottom line margin 29%. We'd expect that to come down a little bit. Now, next thing you'll notice is that there is no cost of sales. So traditionally, a lot of the companies we look at, between the revenue and the operating costs, we have cost of sales. These guys haven't done that because effectively they sell space on a boat, and that space doesn't cost anything because the boat is going anyway. So if you're operating a boat and you're shipping stuff from A to B, obviously takes a little bit more fuel if it's very fully laden, but at the end of the day, to ship a boat costs exactly the same. So these guys are very much an operating cost. This is what's known as an operationally leveraged company, like a hotel, for example, or an infrastructure company. These guys are effectively like infrastructure because they've just got lots and lots of assets, i.e. those boats. So these are the costs of running the business, about 30, 37, 38 billion dollars. And then they come down to this number here, Ebitda. Now, we talk a little bit about Ebitda on some of our videos, earnings before depreciation, amortization, and they also include impairment losses, etc. So Ebitda, earnings before interest, tax, depreciation, and amortization. Okay, now this is a really important number for these guys, and the reason for that is that the interest, and they are paying interest, and we can see that down here. There's the interest they're paying. They are paying interest because they've got a lot of debt. They've got a lot of debt because they've got a lot of assets, and so in order to buy the boats, they borrow the money to buy the boats. So they've got a lot of debt. So they've got a lot of debt. They are paying tax. We can see that down here. They are paying tax. And they can't do anything about that tax. They can structure themselves efficiently, but at the end of the day, they've got to pay tax. They've got to pay interest. So they're kind of looking at things which they can control rather than they can't control. So EBITDA, we often look at as like a controllable profit. The tax is a function of how much profit I make in the jurisdiction I'm operating in, and the tax rate, I can't affect that. The interest is a function of how much I borrowed, and the interest rate, and again, I can't affect or influence those. And the depreciation amortization is a function of all the assets they've got and their useful economic lives. So the only way to get rid of depreciation amortization, that 5 billion that we can see in here, the only way to get rid of that is to sell all the boats. And they don't want to sell the boats because they need the boats to ship all the stuff around the world effectively. And I get into trouble if I use boats with it because they're like vessels or ships. So that's effectively the income statement. Very, very profitable business, massively increased profitability on previous year, but not expected to be sustained. Okay, so just bear that in mind, that this isn't a kind of like 18 billion every year. We'd expect there's going to be a cyclical nature to this business, and they are very much measured on EBITDA. So it'll be very much a metric used around the company, and also it's a good metric for benchmarking against other companies, because you may have other companies with different capital structures, which means basically different amount of debt. Therefore, they'll have different interest payments, different jurisdictions, different tax rates, and maybe different depreciation policies. Depreciation is just the writing off and matching the cost of a tangible asset to its useful economic life. Amortization, matching the cost of an intangible asset to its useful economic life. Tangible assets, something you can touch like a table and chair. Intangible, something you can't touch, like intellectual property rights and patents and licenses and that kind of stuff. And then finally, impairment losses, just over there. The impairment losses is, if you have an asset and you don't use it anymore, you can't carry on depreciating it. You have to write it down. So maybe they've got a crane, and the crane, doesn't fit the new size of container or something, and therefore they just had to scrap it effectively, and that's what an impairment loss is. So there we go, 18 billion, looking pretty good. So let's go on and have a look at the strength of the balance sheet sitting behind this company. So balance sheet is a little bit further down. Here it is. So here's the balance sheet. So non-current assets. So the non-current assets of this company, there's total non-current assets, 46 billion. It's massive, isn't it? And that's really the property, plant and equipment. Right of use assets. Those of you who've seen the videos before will remember that right of use assets is effectively kind of stuff on hire purchase. You kind of own it, but you kind of, you borrowed the money to buy it, so to speak, just in a different kind of structure. And property, plant and equipment, 27 billion. that's going to be boats. It's also going to be warehousing and docking facilities. And these guys, they're very much aiming to be kind of end-to-end supply chain management. So, if you order some stuff from halfway around the world, they say, look, don't you worry about it. We'll pick it up. We'll stick it on a lorry. We'll ship it. We'll put it on a train. We'll take it to the port. We'll clear customs for you. We'll stick it on a boat. We'll ship it to another port. We'll take it off. We'll clear customs there. We'll get it, et cetera, et cetera. So it's really kind of, what they're trying to do is door-to-door delivery. And that's going to include all of the assets, all the stuff that they need in order to conduct that, including things like cranes and, well, this would be all owned by the ports, but, things like, containers and forklift trucks and warehouses and all that kind of stuff, etc., etc. They've got a few other bits and pieces that are investments, but those are the big numbers in their non-current assets. Scrolling down a little bit, looking at the current assets, we can just do that. So here are the current assets down the bottom. First of all, we noticed lots of cash. So lots of cash, $12 billion of cash, significantly up from the previous year. And that's going to be a reflection of those profits that they made. Quite interesting that they got this loan receivable. Not sure exactly what that is. It looks like they've made a loan to another company. It's sort of not something you'd usually find, but it's kind of like, I've got so much cash, what am I going to do with it? I'll make a loan. They got some trade receivables, and then they've got some inventories. Now, these inventories, again, could be a little bit funny for these guys because they don't really hold stock of stuff, and they will have some stock, but not a huge amount of kind of stuff in warehouses, or at least not stuff that is theirs they're trying to sell. It's not like Coca-Cola, who have warehouses full of Coke, for example. And so this will effectively be what's known as a WIP, which stands for work in progress. And effectively, what happens is that these guys, they'll pay for example, a customs, they'll pay some duty on behalf of their client, and they need to bill that to their client. And between paying it and billing, they're going to hold it as a kind of, what they call work in progress. Okay, so it's not kind of stuff in warehouses, it's kind of unbilled client expenses, so to speak. So that's what that number relates to. So there's the assets, total assets, 72 billion, so pretty sizable company here. In terms of the liabilities, here we've got, let's just scroll that a little bit if we can. So here we've got the current and non-current liabilities. So current liabilities, so the non-current liabilities, big numbers is the debt. We can see that jumping out at us. So we've got the lease liabilities and the borrowings. And they've got a little bit of other lease liabilities and borrowings in the current liabilities as well. And that's really the big numbers. There's nothing else jumping out at us. In the non-current liabilities, in the current liabilities, they've got trade payables, which is their suppliers, and a few other payables as well. So total liabilities, about 26 billion. There's the total assets of 72 billion. And you can see, therefore, the difference between those two numbers effectively is the equity, which is this number just up here that we can't see because it's off the top of our screen. So let's have a look at the equity. There it is. So total equity, $46 billion. So these guys don't have a huge amount of debt. And that's kind of reflected in the fact that they're not paying a massive amount of interest, 1.5 billion. I mean, obviously that's 1.5 billion is a lot of interest, but for these guys, it's not a problem, and it's easily affordable. So lots and lots of equity funding this business. And you'll just notice here, this reserves, this will be a lot of that profit which has been retained. Now, the company hasn't paid out, hasn't made a big dividend payment. My understanding is that they have decided to invest a lot of that's kind of supernormal profit, you might call it, if you know your kind of economic terminology. So take that supernormal profit, invest it, and try and reduce their zero carbon targets from 2050 to 2030. So they're not going to just pumping it back out to the shareholders. So there is the balance sheet. Here's the cash flow statement. So once again, the cash flow from operating activities, 22 billion, very, very strong cash flow. Even in the previous year, 7.8 billion. But again, they're going to be making a lot of cash. And that's because of this what we call this non-cash item. So some of you may remember we quite like to compare this number here to EBITDA. It should be reasonably close to EBITDA. And then we've got the cash used for investing. Now, the investing, this is the number we're really interested in here, which is the CapEx. So this is about 3 billion that they're buying new boats and tables and chairs and plant machinery, and they're investing for the future, which is good. And that there's the loan that we saw that kind of popped up, if you remember, on the balance sheet. And again, we're not sure exactly what that is, but they've obviously just said, I've got so much cash, we can just lend it to somebody else, and hopefully they have done their due diligence and we'll get it back. And then the last little bit is the cash flow from financing. So we can see here's the dividend. So a little bit of dividends, a little bit of dividends of previous year. So, only 1 billion of dividends. Don't forget, we're comparing that to 18 billion of profit, reflecting that they really are taking most of that profit, reinvesting it. So 1 billion of dividends, 2 billion of share buybacks. So about 3 billion is being returned back to the shareholders. 15 billion is being reinvested back into the business. And they've also taken the advantage of some of that positive cash flow to pay down their debt. So you're seeing a company which has got lots and lots of equity, really strengthening that balance sheet. These guys are not going anywhere in, they're certainly not kind of wobbling or gonna fall over in the near future. So really, really a strong set of accounts here. Here's the movement in equity, and this is where we can see if I can just get this thing to move around a bit. I'm just going to try and scroll out a bit. There we go. So here we can see the retained earnings, and once again, let me just annotate this so we can see there's the profit from the previous year. That's the profit from last year, and there are the dividends they're paying out and the share buybacks. And then in this year, there's the profit that they make. There's a little bit of minority interest, so that's the number we saw in the face of the P&L account. And there's the dividends to the shareholders. There are the share buybacks, and we saw both of those in the cash flow statement. So really, these guys are absolutely solid as a rock. I mean, there's there's absolutely no problems at all. Very strong profit margins, although they kind of realize that those probably won't last forever. But they've taken the opportunity not to kind of just distribute the money, but to pay down debt, and they are reinvesting it back into the business. In terms of their share price, quite interesting this. So when we think about the certainly the market cap, so 373 billion compared with the shareholders funds of 45 billion, it's not cheap. Obviously the difference between 375 and 45 is whatever it is, 330 or something. There's a lot of goodwill in there. You'll notice that they've come off a little bit. So I kind of get a feeling that this increase here is really driven around that kind of they're going to make, they're going to start to show that kind of big profit, and this is coming down when suddenly maybe the shareholders are thinking we're not going to get the whole lot paid out to us in the form of a dividend. So quite interesting. There's no P ratio. I don't quite understand why there's no P ratio or no dividend yield shown here, because you'd expect that there would be. There's obviously is a significant earnings, and if we take 375, if we take the 373, for example, and we compare it to earnings of 18, then we end up with a P ratio of about 21 times. Okay, now 21 times earnings is very expensive if you know that the earnings are going to correct back down again. So look at the trading range for these guys. They're kind of, they're very much sitting in this trading, and they kind of bounce around in that trading range. So, life is good, life is bad, life is good, life is bad, good, bad, good, bad, good, bad. And that's kind of the cyclical nature of this kind of a business. So, there's an element that, if you're a chartist, you get very overexcited because you start to do things like head and shoulders and kind of levels of support and all that kind of stuff. And you start to kind of write. So this guy, it looks like it's broken out of the top. looks like it's coming back down again. So you might kind of say, well, when it gets back down to here, that's the buy signal because it's going to go up, and that's your sell signal. Obviously, if you'd sold out here, you'd be kicking yourself because you really want to get the top of the market. But then, you know, who can time for the top of the market? So there you go. There is Maersk in a nutshell. Hopefully, that's a useful kind of tour of the world's largest shipping company. Once again, don't forget to like, share, subscribe to the channel. Do leave us your thoughts. If you want me to look at another video, another company, sorry, then please do leave your comments in the comment section. And again, if you can give me a little bit of information as to why you find it's interesting, something funny going on in the account, some angle that you're looking at, it makes it a lot more interesting than just say, you know, Ted, can you have a look at XYZ PLC, for example. So otherwise, until the next time, see you later.